Hey there, welcome to another episode of the Everyday Trader. This is Eric Hale. Happy holidays. Glad to see everybody here. Greg and I took a break uh, over the holiday season and spent time with family and stuff like that. So we skipped a few weeks and we're still getting started up after the first of the year. So I went ahead and decided that I'd do a quick little one of these videos to catch up and talk about some stuff that's going on. So this week, today's the 5th of January. So we're ending the first week of January, which historically there's a so one of these things that have been identified by the Stock Traders Almanac. So I don't know what do you call it, but there's this thing called the January effect, and that is that as January goes, so goes the year. And there's also another saying that the first week of January tends to tell us how January is going to go. So it looks like we're going to finish the week down. We are having a bullish day today, but we've had several bad days. I think a lot of that is just profit taking. There hasn't been any real significant indications of anything. We had some economic news this week, and yeah, so January's first 5 days is an early warning season. The last 47 up first 5 days were followed by full year returns 39 times. So 83% of the time if the first week's up. And then there are some exceptions that had to do with war in Vietnam. Um, so that's up weeks. There's a January barometer, which only has 12 significant errors in 72 years. And this is the barometer states that the S&P 500 goes in as the S&P 500 goes in January, so it goes the whole year. The indicators registered 12 major errors. So most of the time, and this is also 83.3% accuracy. So we're going to keep an eye on how January goes. A lot of us finished our forecast. If those of you who are members of Options Animal, we do an end of the year summary where we all make forecasts. We do our prognostications and we look back at the previous year in terms of what we predicted would happen. We do stock picks and we also do estimates on the S&P 500. I happen to come within 1% of the final year, which wasn't an accident because I just picked the 52-week high or the previous all-time high. So we came within 1% of hitting that all-time high on the S&P 500 in 2023. So my forecast for this year for the S&P 500 is 54 20 69. So 5 4 20 69. Yeah, that's the truth is there's some logic behind it, and I came up with a number that came up to 5,400 and change. And so I'm being a little bit silly. Anybody who's an Elon Musk fan will catch the reference. So that's my forecast, which most of the people, except for Greg, who forecasted where we think we're going to be in 2024, we're all bullish. Now, we all tend to be subject to this recency bias, and that is we are very much affected by what happened most recently. So this is not an unknown phenomenon, and we had a very, very bullish end to the year. And so I think that might have affected people's forecast. Although I've been pretty bullish most years, I think I've only forecasted one down year over the past decade. Anyways, yeah. So what's the big news that's going on this week? We had two really significant things, and one was the FOMC, Federal Open Market Committee, the Federal Reserve's Open Market Committee minutes were shared from last month. And we saw the press conference last year, or yeah, actually it was technically last year, and Chair Powell spoke. And the message that came away, people took a very dovish stance. And if you read the notes, it wasn't quite as dovish that they weren't talking about rates. So what happened in December was the Federal Reserve provide, or the FOMC committee members provide a forecast of where they think various numbers are going to be in the future. And you can extrapolate from where they think rates will be and where inflation will be the end of 2024 that we were going to have 4 rate cuts. And that's what was in the dot plots. It's called the Summary of Economic Projections, the SEP. So that doesn't mean that there were rate cuts discussed. It's a forecast. So I mentioned that Options Animal, we do a forecast of where we think things are going to be. We don't have any control over it, right? This is just what we think is going to happen. And of course, the FOMC does have a little bit more control over it, but it's just where they think things were heading. And they're all forecasting that inflation would be under control and that we'd have lower rates. And so the press really took that to be some sort of announcement. Although if you read the minutes, the FOMC minutes from this week, that's not what was said at all. There's no intention of, or there was no explicit discussion of cutting rates or when we're going to cut rates. I still believe the Fed's going to be data dependent. Hey, at this point, one of the things I was thinking about is that some of you listening hear us talking about the FOMC, but you might not know sort of the bigger picture. And this thing came across my desk this week from Wells Fargo, and they called it the FOMC 101. And I think it might be helpful if I share this with you. Let me pop this up here. So this is just a really simple one pager that gives you an overview. When you hear people talk about the FOMC, this might be helpful for some of you to understand. So the Federal Open Market Committee, which is part of the Federal Reserve. So the Federal Reserve does 2 main tasks. One of those things is supervision of banks, and the other is monetary policy. And they have a balance sheet where the Fed buys things, and then they also set the risk-free interest rate or the Fed funds rate that institutions borrow at. So we're not talking about the supervision side of the business, but from the monetary policy side, the FOMC Federal Open Market Committee has 12 members. So there are 7 permanent members, and Jerome Powell is the chairman of the FOMC. And also on that board are Philip Jefferson, who's the board, technically the vice chair board of governors. And then we got Michael Barr. You might have heard his name mentioned. He's vice chair of supervision. So he's responsible for supervision, but has a seat on the FOMC committee for monetary policy. And then we've got Michelle Bowman, Chris Waller, Lisa Cook, and Adriana Kugler. So these are, and Lisa and Adriana are the 2 most recent that have only been added on here in the past like 6 months or so. These are permanent members of the FOMC. They work together. These 6 work together with Jerome Powell to confer. They each have staffs. They have people that work for them and help them do research. You also notice these N, 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 H, H, D, D, and those are sort of informal designations. This is, according to Bloomberg, either labels them as a hawk, a neutral, or a dove. So a hawk is somebody that's more likely to be more restrictive in terms of monetary policy. So they're less likely to be cutting rates. They're more likely to be raising rates and making things a little bit more tougher. And you might have heard Greg and I talk. Greg and I have spent some time with Chris Waller, Loretta, and Tom Barkin. Also, we've met a few times. I met Raphael Bostix, vice president of research. So we talk with some of these people. There's other members, former members, who are sometimes the best people to talk to. If you've wanted to find out, and I've heard this said before, is if you really want to know what the FOMC is thinking, talk to a former member, because they can be a little more candid in talking. There's been some pretty major changes that have happened on the FOMC, but so there's the 6 members plus the chairman. So there's 7 that are on the board of governors. Then there's the voting districts. So John Williams, who is the vice chair of the FOMC and also the New York Fed president. So he's the Fed of there's, what is it? What, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Is that 12, right? So that's, yeah, 12. So there's 12 regional Federal Reserve offices or districts, 12 Fed districts. New York, Cleveland, Richmond, Atlanta, San Francisco, Chicago, Boston, St. Louis, Kansas City, Philadelphia, Dallas, and Minneapolis. So those are where the Fed districts are. Did anybody notice anything, by the way? Why does Missouri have two Fed offices? So this is Kansas City, Missouri, and St. Louis, Missouri. They have two Fed districts. There's a reason, but it's kind of interesting. And their regions like this Kansas City. So Jeff Smith, who's the acting, oh no, is he acting? No, I guess he's applied. They just announced a new St. Louis district president here just this week, actually. And I forget exactly who that. Yeah, then if you said the name, I'd say that's it. He's got a name that's something like Islam or something like the last name's like Islam or something like that. So something, yeah, I'm not exactly sure. But there is now a permanently named person who is the head of the St. Louis Federal Reserve. But Kansas City, that's the Jackson Hole. Jackson Hole, Wyoming is in Kansas City's district. So the districts are kind of weird. Anyways, so they rotate as to who can vote. So this year, John Williams always votes. And then Loretta, Tom Barkin, Raphael Bostic, and Mary Daly are the voting members from the Fed districts this year. So next year it'll be Chicago, who's Austin Goolsbee. Yes, I know Austin. I've met him a few times and was with him in December. By the way, I don't want to brag, but I'm going to brag a little bit because I did receive this certificate in forecasting excellent presented to Eric Hale. So from the Federal Reserve. Yeah, take that and that and $4 will get me a coffee down at Starbucks. Anyways, that was at the Chicago Federal Reserve outlook that I was at. I don't know if we talked about it here. Anyway, so yeah. All right, so back to the Federal Reserve. So there's the 6 members plus Jerome Powell, so 7 people in the Board of Governors, and then there's 5 voting districts where John Williams, not because he's John Williams, but because he's the New York president, which is probably the most significant of all of the districts, votes permanently. And so these 4 rotate: Loretta Mester from Cleveland, Tom Barkin, Richmond, Raphael Bostic, Atlanta, Mary Daly. So next year it'll be Goolsbee and Collins and whoever takes the St. Louis, and then also Kansas City will vote. And then the following year it's Cleveland, Philadelphia, Dallas, and then the next year Chicago, Richmond. So they rotate who is on this of these 4 people voting. And here's the FOMC meetings. So we've got meetings January 30th this year, March 19th, April 30th, June 11th, July 30th, September 17th, November 6th, and December 17th. So there's only 8 meetings that happen. And then after the meeting, we find out the meeting minutes, which is what was released today or on Wednesday this week, were the meeting minutes from December. So anyways, you hear us talk about the Federal Reserve, and I thought this was helpful as a good little 1-page explainer. And thanks to Wells Fargo for explaining how this all works. There you go. So that's the Federal Reserve, right? And so that was one of the things today. The other thing, of course, was the jobs report. And we had a phenomenally good jobs report today, which is interesting because the market responded very positively to it. And I haven't actually done this yet, but I like to look at the CME FedWatch tool, speaking of the Federal Reserve, because it has a dramatic impact. So Fed monetary policy has a big impact on the economy. And the question everybody is asking is how many rate cuts? I'll go back over and share that screen again. So you can find this by just do a Google search for CME FedWatch. And what I like to look at is so we have a meeting the 31st. And if we're looking at what I'm looking at here when I click compare is what the probabilities were yesterday versus a week ago and a month ago. So we are at 93% probability that we stay, and then a small probability maybe that we cut rates. March, so not this week, I guess this week, so a week ago, yeah, so today's job number didn't really change anything. So this is yesterday, the 4th versus today, and this does update in real time. So this yesterday, there's really no change in the probability that the Fed is going to cut or raise rates. So it looks like today's news was essentially a wash comparing yesterday to today. Although if we go to a week ago, we did see a drop and over here an increase. Like actually, yeah, this is where we are right now. It's 525, 550. So there's a slight probability increasing that we maintain rates. So a week ago, we were at 90 or whatever that works, so 81% or 89% chance of the opposite of that. So it's 11.5. So be 1185. Yeah. No, sorry. 88.5% probability that we cut rates was the probability a week ago. And now we're at a 67% chance of us cutting rates. And there's this probabilities window that we look at. So where we are right now is this 525, and we're forecasting, here's the probabilities of where we think the blue is based on Fed fund futures, and we're estimating some pricing. I think there's some reasons to be skeptical of these numbers, but right now, I think what happened, the point is that today's number was good in the market. So we had a big move in the S&P 500 because the number wasn't too good. It was good, but not too good. And it wasn't bad. Now, if the number was bad, my prediction was that we would have seen the market rally more. So if we had a bad jobs report, that would increase the probability of us lowering rates. So a bad jobs report means that the economy is starting to slip, and right now we don't need the Fed pushing on the brakes. That's sort of the argument. Personally, I think it's worthwhile looking at what happens when the Fed cuts rates. And it really comes down to two different scenarios. Here's let me show you. This is what I shared last week with the options animal community. So what this is looking at is 10 times when we've cut rates. So this is showing the Federal Reserve, either the Federal Reserve cutting rates. So there's been 10 times where that's happened, or sorry, 11 times. So the average is the blue line, or the dark blue line. The light blue line, this bad line that you can all see here, is when we are cutting rates because we're in a recession. So the real question comes down to, are we in a recession, or will we be in a recession when the Fed eventually cuts rates? I still think we're 6 months off. I will be very surprised if we cut rates in March. In fact, I've even gone so boldly as to say I will eat a shoe if we cut rates in March. I think we're probably not going to, that's probably not going to happen, but I'm definitely an outlier, but the market's starting to move in the direction that I believe. And that's okay, because the market usually does, the S&P 500 does the best if we look at these periods. So the Fed can raise rates, Fed can cut rate, or the Fed can hold. If we look at all three of those, the time that the S&P 500 does the best is when the Fed doesn't do anything, when the Fed holds rates. It's the best thing for the market. So us cutting rates could be good for the market if you subtract out the bad years, which are recession years. That is definitely the best return that we'd have. And so the best case scenario for your portfolio would be for the Fed to take its foot off the brakes, and we're not in a recession. So what is it going to take for that to happen? Inflation has to be back down in the twos. And that, I don't even think it's worth a discussion until we see that. But it is all that's going to consume us. Oh, it's not the only thing that's going to consume us here in 2024. We've got several big things that are happening, both short term and long term, uh, throughout the year. So immediately facing us is the potential for another government shutdown. And uh, we did have a bill. Speaker McCarthy passed something that was it McCarthy? No, who's our new speaker? I don't know what he's as McCarthy's gone. It's the new guy. Anyways, Congress kicked. Is it McCarthy? Anyways, Congress kicked down the can. You guys tell me in the chat. I'll figure it out. It'll come to me later. Congress kicked the can down the road into January, and I've been watching the Fed, the VIX futures, and it's flashing significant warning signs in January. So there's something in January that is causing the forecast of volatility to be higher. That I can say unequivocally. That the market is forecasting more volatility this month, and it's different. It's more than they're forecasting in February or March. So it's in January. Something in January has the market forecasting volatility. And I happen to think that it's the government shutting down. And what's consuming the news right now is, okay, so we're going to shut down the government unless we get the border under control or something like that. So whatever happens there is going to happen. There very well could be a government shutdown. And in the end, it's not going to make much of a difference, in my opinion, whether we shut it down or not. But it will cause probably some sort of sentimental issues if we do shut down, probably an adverse sentimental pullback, which would probably be a buying opportunity. The other thing is the Iowa caucuses kick off in 8 days or 10 days. So Iowa caucus is the first, then New Hampshire, and then we got Super Tuesday coming up. So we start getting into the election period, and that's going to consume a lot of stuff here. And I'm personally on record as saying I don't think that the election is going to have any significant impact to the market. The odds are it's going to be Trump and Biden, and the market knows both. So I think from a market standpoint, now that's, you may like it or hate it, and that I totally respect that on either side. I don't really like the choices personally, but I think that I think the market, it's a good thing for the market. So what we need to watch out for is, the unknown unknowns. So some other sort of regional crisis that is bigger than the two that we already have going on. Maybe something with China, or some sort of a gray swan or a gray rhino, which is not a black swan, but I mean, there could be a black swan too, but by definition, you don't know what a black swan is. So aliens invading the planet, maybe, or AI sentience, something like that could happen. I'm laughing, but I'm not laughing because this is another interesting piece that crossed my desk this week. Was a piece by Bank of America that showed all the bad stuff that could potentially happen. Let me see if I can find this real quick. So this is published yesterday. This is Bank of America Institute. Yeah, here we go. You ready for this? If you aren't already losing sleep, so they published this report. You do full page. Where's full page? Rotate, view, zoom. Whatever. Okay, here it is. Uh, it's probably there. You probably see it. And you're like, Eric. So this is all the possible things that can go bad in the world. And we've got things like structural failures in the health system and weakening of human rights and COVID and energy supply crisis, cost of living crisis. But no, this gets better. Let me go to the end here. Where's all the things? So extreme weather, cybergeddon, super bug resistance, wildfires, job automation, private surveillance, inequality. These are gray swans or rhinos. There are things that we know can happen. So black swans with bioweapons, solar flares, mega quakes, mega volcanic eruption, asteroid impact, aliens, AI singularity. Yeah, I don't know. I don't know what the key takeaway is. I don't even know what my point was, but this report is like if you're having trouble falling asleep, you're probably not going to be able to sleep after looking at this report. But I suppose it's good that people are looking at it so that they're thinking ahead of time. Um, yeah, I don't have any key takeaway from that. My thoughts though are, is there some way to make money off of this? If people are going to be preparing for these sort of events, what sort of things, what businesses would benefit from it? I think cybersecurity is probably one that um, maybe is one of those areas that's not ever going to go away and probably only going to get worse, especially with cybersecurity. So I don't know, maybe somebody like Apollo. I'm not an expert in this area, but Palo Alto Networks I know is a name that comes up when we talk about cybersecurity. Okay, so one other name that I wanted to talk about, and that's Apple. I've got a strategy going on right now. Apple's been getting pummeled this year. I think a lot of that is probably just profit taking. So if we look at the stock chart has been since the first of the year. Well, yeah, there's December 28th and then 29th, the last day of trading. And then the first 4 days have been terrible for Apple. And I don't know where Apple's going. I think there's reasons to be bullish and bearish. We had two downgrades this week, but yeah, companies like Goldman Sachs and even what's his name, Gene Munster are. I'm not sharing the screen, am I? Share screen. There we go. So yeah, here's Apple. We've got this was the last trading day of the year, which was a little weak, and then we've had very weak beginning into the year. So a strategy that I think is pretty interesting on Apple, and I have this going on and a couple others going on in Apple, but I was looking at modeling a trade today that's kind of compelling, and that's actually an in the money covered call. And you might ask, why would you do an in the money covered call? And when I modeled this up, so the stock is trading at 180, 118. You could sell 180. Is that right? Yeah, you could sell a 180 call for 390. Oh, I'm sorry. I did this when the stock was at 180.50. So it's gone up a little bit. So there was a little recovery into the end here. So this pricing's a little bit different now, but I'm going to run with these numbers. So about a half an hour before the close, this was the price. The stock was at 180.50, and the call that I was looking at selling is the 26th of January. So we have a earnings event coming up the week after. I think this was a pretty interesting trade. I think most people screw up covered calls because they don't actually let their shares get assigned. If you want to know where you make the most money on a covered call, it's if your short call gets assigned and you close this trade. So you're looking at a cost basis in terms of capital is 176.61 with a max profit of 340. And is that good? It's actually very good. If you do the math and you consider an annualized return, you've got, let me make that bigger. So if we place this trade today, yeah, so it's a 21 duration trade, so 3 weeks. The return of 340, so that's that $340. And 176.61 is the risk and the capital that I have in the trade. That's the most that I can lose. Works out to be a 1.9% annualized, I'm sorry, 1.9% return on risk. So almost 2%. But making 1.9% in 21 days is a 33% annualized return on risk. And you've got a 71% chance of making any profit. So going back over here to the chart, this support level 176.61, when I modeled this, that you've got protection all the way down here. The stock could drop significantly more and you still could break even here. So the stock turns around and goes up. You would miss out on significant upside potentially, but you got to ask yourself, if the stock goes to 180 and a penny, I make 340. If it goes to 190 or 200 or pick any number above that, you still make the $340. Is that okay? I think making 33% annualized return is pretty good, especially considering you've got a high probability of this trade making money and the stock could drop down significantly and you still have a break even. So maybe you don't even need to buy a put to protect this thing because you've got significant protection to the downside. I've got about $5, $4.50 of protection if the stock moves down. So the type of strategy that I like to do all the time. And you've got to ask the question, what happens if the stock does go down? And what if the stock expires between here and there? And that's what we spend time talking about in our community. But I'm not out here looking to hit home runs with my trading. I want to consistently get base hits where I'm going to score and win most of the time, which I do. My track record is fantastic, and it's because I do swing for the fences sometimes, but I don't swing for the fences all the time. It's about being conservative and sticking with what you know and what you're comfortable. There's all kinds of new equities out there to trade and new strategies and everything from 0-day options and people doing some other exotic sort of trades, and that's great. But I'm able to keep my attention focused on strategies that I'm comfortable with and that work for me. And I'm fine with other people making money on Bitcoin or 0-day options. That's great. I'm okay with that because I do very well sticking to what I know and get results, like we just shared here. Anyways, this is a short one. I'm sorry it took so long for us to get Everyday Trader out for you again. Hopefully this was helpful, and look forward to seeing you all around real soon.